Welcome back to another episode of Travis, Can I Have This? I am very excited about today's topic, more excited than I should be, as I am with most topics. We're talking about accounting. Who wants to talk about this? But, accountants, we're conservative folks. We like black and white things. But today we are going into the gray area. And one of the things I love as an accountant is when I hear non-accountants giving tax advice. And one of the most non-accountant tax things I hear is people saying, you got to have an S-Corp. They're not even audited by the IRS. They never get audited. You can do whatever you want in your S-Corp. And today we're going to talk about that. Is that true? Are S-Corps really kind of free game to do whatever you want? Does the IRS really audit them less? And if they do, what does that mean? We're going to get into it. And there's some things today that, going to be a little bit gray. And right now it's June gloom where I'm at. So let's get into the grayness and enjoy it. At the end, I'm going to give you 5 questions you should think about when you think about deducting something for your business, for your practice. Let's go. All right, before we go, we are talking about doctors who own their business, doctor-owned practices. And when it comes to doctor-owned practices, my specialty doing accounting for this space is, you have, let's just say 1 location to 5 locations. You're not like doing a big complicated DSO type structure. You're not in a big group, anything like that. This is the kind of entity structure we're talking about. And in today's world, there's really 2 choices. You can be an S corporation or you can be a sole proprietor. Now there's other options kind of, but like really 99% of people are choosing one of those options in this 5 locations or less type world. Now you might be saying, well, I have an LLC. If you have an LLC, you actually get to pick. Do you want that LLC to be taxed as a sole proprietor or an S corp? Again, those are really your 2 options. You can't, the IRS doesn't recognize LLCs. They make you pick. If you don't even pick, the default is a sole proprietor. So these are your 2 options, sole proprietor or S corporation. Well, an S corporation means you file a separate tax return called an 1120S, and a sole proprietor means that your business is reported as part of your personal tax return. Your personal tax return is Form 1040, and a sole proprietor is Schedule C, which is part of your 1040. So your options are to have a separate corporate tax return or to put it in as part of your individual tax return. And which of those options will give you less audit risk? And the short answer is let's look at some data in that. So we are comparing 1120S versus 1040s. Now, when we compare the sole proprietor option, which is 1040s, that's wrapping your business into all of your other personal stuff, real estate stuff, charitable stuff, whatever other personal stuff you have going on, it's getting wrapped up with your business. And what that ultimately does is it opens up more opportunities for the IRS to audit you. With an S corporation, there's a flow-through entity, pass-through entity, and there's more separation. And for whatever reason, it is true, looking at the data, that S corporations are indeed audited less than individual tax returns. And not only are they audited less, but looking over the past 15 years, all audits in general have gotten less. Now, I was trying to poke around before this episode, doing some research, and there's an IRS data book where they release certain data about auditing things, and a lot of stuff in there. But I think what I got, I think it's legit. In 2010, we are talking, according to the data, 1 in every 800 S corps was audited. So 800 S corporation tax returns were filed. 1 of them was audited. Today, the most recent data we're looking at is 12 5,000 S-Corp tax returns are filed, and one of them is audited. 0.008%. That is extremely low. Now, sole proprietors on the other side, in 2010, it was 1 in 50 sole proprietors were audited. I don't know if that's true. Maybe just 1 in 50 individual tax returns. One interesting data set in 2010 that was out there was if your income was lower than like 50,000, you had a higher chance of getting audited. Like, why? Why? Just great. I don't know. That seems like a waste of IRS resources, in my opinion. But maybe just people trying to get to zero income, I guess. I don't know. I guess I'm hopeful that the IRS knows what they're doing, but we know they're not always. Today, so 1 in 50, 2010, sole proprietors. Again, I don't think that was true, but that's what this data research said. Now it says 1 in every 5,000 is audited. So either way, however you look at it, both like overall audits for any type of entity is becoming less and less rare. And then if you've been following the news in the year 2025, you know that the IRS, this was before IRS cuts in 2025, and then they went through significant cuts in 2025. So if we're guesstimating what the future is going to hold, audits are probably going to look pretty sparse, and they are 2-3 times more sparse with an S corporation. So yes, from what I could find in the data out there, S corporations are audited less than sole proprietors. Now, the sole proprietor data, it's not really like 100% accurate because we don't know if the 1040s that were getting audited had Schedule C sole proprietors. So it's a greater pool and greater set of issues, but you know, there's more opportunity there. Also, of the S corporations that did get audited, we don't know how many of those started with a individual tax return audit. So I've been a part of a couple S corporation audits myself. I don't want to brag or anything. It's pretty rare, right? But I've been a couple of these. They both started with the individual tax return getting audited. And then as they're auditing that, they're like, well, let's get the S corporation in here too. And then they add the S corporation as part of the audit. But it didn't start with the S corporation. So if your individual tax return is squeaky clean, then do all the shenanigans you want in the S-Corp, right? Is that what I'm saying? No, that's not what I'm saying. You got to be, you got to have your head on a swivel no matter what. And so what does this mean? So from an, if you're paranoid of audits and all, you're going to, work your life around avoiding an audit, which let me tell you, audits are not that scary most of the time unless you're doing crazy stuff. But, it's not like the scariest thing in the world. I wouldn't lose any sleep over getting an audit, but you may have to pay some money back if you don't have your ducks in a row. So S corps are audited less. So what does that mean? Let's distinguish a couple things before you start, telling your wife you're going to start paying for everything in your home through your S corporation. There, you probably heard this term, and accountants say this all the time, and it's super annoying, but there's a difference between tax avoidance and tax evasion. Tax avoidance is legal, strategic planning. Tax evasion is illegal. And even though S corporations are audited less, does not mean you can do illegal things. And I always talk to clients, when we talk to clients and we try to get a sense on their risk profile, because there are certain things that are gray area. They're not illegal. They're a gray area, and you can potentially do those types of things, but you need to be okay with taking on that risk. People, will usually say, well, I don't want to do anything illegal. But then, they kind of are okay doing things illegal, and you shouldn't be. Don't do anything illegal. And you should try to work with an accountant who, if you're doing something illegal, they'll tell you that they're illegal. Now, I will tell you, every year I go around the sun and I do another tax season and I see another set of stuff, and I get to understand the tax code better. And the tax code is getting longer. It's getting more complicated. During COVID, there was so much legislation rolled out, and I was trying to stay on top of it. And I will tell you, there are so many gray areas in the tax code. There are so many things where You look at your specific situation and you're trying to apply it with the tax law, and it is absolutely unclear what to do. And people will usually have, there's a certain type of people, the black and white type people, that are like, oh, if it's not clear, I'm going to do the most conservative thing. I'm not going to touch anything that's unclear. There's other people that are like, oh, it's unclear and it will save me $10,000. Okay, yeah, let's do that because it's not clear that it's a no, right? So there's people on both sides of the spectrum. And honestly, you could do either in the gray area, but the IRS has language around this and they understand that, you may need to do this. And they have these like terms that get thrown around a lot, like ordinary and necessary. Is what you're doing ordinary and necessary for a dental practice? And they kind of use that as a guide. Or, is there a reasonable basis for taking this? Is there substantial authority on taking these positions? And so there's certain guideposts around, the intent of what you're doing, which is a good compass to have. There is a form, 8275. No one's ever going to remember. I don't even know why I said the number, but there's a form that you can fill out to disclose to the IRS, hey, this is a gray area. I'm taking this position, and here's why I'm taking this position. You can actually tell them what you're doing, and doing that, they like it. They're like, oh, they're filling out the form. Good for them, right? I think there's some good things. Now, people think, oh, well, now I'm drawing a red flag. They're going to know that, right? But just know you can be aggressive, but you need to have a case on why you're being aggressive. You need to document it and disclose it where needed. We're not trying to lie here, right? So there's a big difference on some of these things. There's always going to be people taking kind of aggressive positions on things. So I'll just talk about a couple things. I don't know. These just came up in ChatGPT, and I was like, I don't know if I want to talk about this because I don't know the answer. I mean, I would not advise my client to do this. Can I deduct my Tesla as a marketing expense? I don't think so. How is that marketing for the business? That doesn't seem ordinary and necessary to me. A big one with an S corporation is you have to pay yourself a W-2. That's a whole nother topic for another day. You got to pay yourself a W-2, but you want to pay yourself as little as possible because you pay payroll taxes on it. So some doctors pay themselves $10,000 in W-2 wages, and then they take $200,000 of distributions. That I would say is borderline illegal. That's against the guidance that they gave. Maybe you could argue it's aggressive, but I wouldn't do it, right? There's these things that clearly are red flags, and the wages one is something that's very easy for the IRS to flag. Now, do they flag it and do they go after it? Probably not as often as they could. But a couple other examples that I just want to throw out there, like meals. Let's talk about meals. If you get audited from the IRS, one of the first things they're going to do is go after your meals expense. It's just every audit, every CPA here out there talk about, they're going to go after your meals expense and your auto expense and your travel expense. That's where they know you're sloppy and we're going to get some money back from you. So let's say meals. Let's say you have a bunch of meals this past year. The IRS technically expects you to keep documentation of your meals and why it was a business meal, right? So if they look at your records and you deducted 300 trips to Starbucks and each trip was the cost of one coffee, they're going to argue there was no business. You were there by yourself. You weren't doing business with someone else every day of the year. You're just on your way to work and you got a coffee every day, right? So they're going to go after that type of stuff. But let's just say you're technically supposed to have documentation on your meals and receipts and why it was business purpose. Even though you might have it on a credit card statement, you need to have a receipt according to the IRS. And this is laborious for a lot of business owners. I'm not saying you shouldn't do it. I mean, the IRS has their rule. But let's just say you get to the end of the year, you have a bunch of meals and you think they're all business related, but you don't have documentation for it. Can you still deduct those meals? Most people do, but is that illegal? Again, I don't know if it's clearly illegal or legal either way, but it's probably just, mistake. I don't know if it's grossly negligent and the IRS would penalize you for it. They could. It depends on the auditor and the situation and how much your meals are. But if you don't have receipts, but you believe that those meals were legitimately business, that's probably not illegal, right? But you aren't all buttoned up like you should be. But you're saying to yourself, well, there's a rare chance my S-Corp is going to get audited. If it does, I'll just take the risk that I will lose out on the deduction of these meals. And you get audited and the IRS says, hey, you can't deduct those meals. You owe some money. You might owe some penalties. That's unlikely to happen. But if it does, I'll take that risk. And now I don't have to keep all these receipts, right? That could be a justification that you take. And I don't know if it's clear, my research, if that's legal or not, but I think, it depends on the situation, the facts and circumstances around what you're doing. But that's a very common thing, I would say. Now, alternative is now with ChatGPT is really good at coming up with fake receipts. And let's just say you had a bunch of stuff that was personal and you put it in through the business and you make up fake business receipts. You could certainly do that. And that's certainly fraud. That is illegal. Sure, maybe there's a chance your S-Corp doesn't get audited, but that is not what you're supposed to do. And I would not do that. That's very different than having a legitimate business meal and not having the receipt versus making up business meals that weren't actually business meals. So very different. And, you do not want to do the illegal stuff, primarily because if it's caught that it's illegal. Another example is underreporting income. If you got a lot of money in cash and there's no trace on it and you don't report it and the IRS is able to somehow find out, that's illegal. So shouldn't do that. And just other things, misclassifying personal things as business, is it, a good example is gym memberships. People do this all the time. My gym membership, it's business, I need to stay fit. I shouldn't use that example because people argue that a lot too much, but just clearly personal things, your kids' clothes, right? Buying your kids' clothes is clearly not a business thing, but people put as business. I think that's, going to the extreme of being illegal, not just being I don't have my records together. So be careful about these things and just know that there's a difference. You can be aggressive, but you need to have an argument on why you're taking that position and being able to defend it. So let's talk about 5 questions you should ask yourself if you're not sure what you should do. We're probably going to do an episode just on meals, just on automobiles, just on travel. Those are really important topics. People aren't sure where to go. So we can talk more about those in more detail. But at the end of the day, if you're okay taking on an aggressive position and more risk, you can certainly do that. But make sure you have an argument on why it's business. And think to yourself, would I feel good explaining this to an IRS agent in person? So that's the first question. Would I feel good? I feel good. Yes, this electric scooter was business expense for my dental practice because my staff really gets stressed out and they need to take a loop around the block. And that's what we use it for. It's okay, you're going to try to explain that to the IRS agent and see if they buy on. But if you feel good about it, imagine that day coming. Number 2, do I have the documentation to back this up or at least make a good case? Right now, documentation is an interesting one because, the IRS wants you to have receipts for those business meals. They want to see your mileage logs, your calendar notes, emails. They want to see a paper trail of stuff to document, what you're doing. It is hard to be as vigilant as the IRS wants you to be. Some people are. Some people crush it in this documentation category. But do the best you can. And do you feel like you have the right documentation to back that up? Oh yeah, we had a scooter log in our office. You want to go see our scooter log? And when people would go take a scooter around the block, they would log out and log back in, log how many miles they went. They would log their fun level on a scale of 1 to 10. Look at our scooter log here. They actually did use it, right? That's documentation to support the expense. Is there a clear business purpose? This one, You got to make sure, again, I like to use the term ordinary and necessary that the IRS uses. So I had a client that wanted to deduct their dog because it reduced anxiety for them. You know, I don't disagree. I wish I had a dog in my office. I think that would help my anxiety levels. But like, you know, you also do other things with your dog, play fetch with your dog. That's a lot of fun, and that's not a business purpose, right? And so it'd be a hard time. Like, you got to have a business purpose. Number 4, is it supported by actual tax code, a court case, or common practice? This is a really good one, you know, that you probably can't do on your own. Hopefully your CPA can help you. Like, dig into the tax code. What does the tax code say about this? A, and B, what's case law say about this? My favorite case law stuff to go into is uniforms, right? Like, people are always like buying, like, you know, I got to have pants, so I'm going to go to Nordstrom and buy some really nice pants. And the IRS has, you know, a lot of cases around that. And you can look at case law and see, you know, how have the tax courts ruled in that about those pants. There's probably no case law about scooters taking loops around the office, though. I bet you that one. Number 5, am I taking this position because I think it's legit or just because I think I won't get caught? You know, I don't know. I'm not judging. I'm not judging here, but you know, you want to have some use case. And I like that number 1. The number 1 question: would I feel good explaining this to IRS agent in person? Again, these IRS agents, they're just doing their job, but you know, their job is also to get money back. So if you don't have a good case and documentation behind it, there's a good chance they won't allow it. All right, that's it. So S corporations, in summary, they are audited less, yes. So that means you can do whatever the heck you want. Not really. You still got to have your head on straight. Can you take more aggressive positions? Probably, you know. But if an audit scares the bejeebies out of you, just don't do it, you know. 1 in 12,000. 1 in 12,000 get audited. Is that? I guess that's what the data says. All right, we're out. Thanks, guys.